This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, December the 9th, 2014. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term confidence and sentiment. This month I'd like to cover a range of topics centered around energy and oil, and they're listed here in the sequence that I'd like to go through. The drop in oil prices has been a shock to the global financial system. We normally don't think of a fall in prices as creating shocks, but make no mistake about it, this is just as serious as a rise of the same magnitude. This has been a historic month in the oil markets, and the drama will likely increase over the next few quarters. There are four main causes for the current dramatic moves in oil and energy prices. First and most obvious is the growth of the U.S. shale oil production. Thanks to the shale oil revolution, the United States is now producing almost 9 million barrels per day, the most in 30 years. By the end of next year, the U.S. production will be approaching 10 million barrels per day. So even with one, most Iranian oil fields off the markets due to sanctions, and two, with Iraq oil production at somewhere near a quarter of what it could have been had there been peace in that country during the last decade, global output is actually increasing sharply. According to the International Energy Agency, IEA, global supply was 93.8 million barrels per day in September this year, up 2.8 million barrels from 1 year earlier. The second reason is that global demand for oil is weak. Demand from China is growing much more slowly than had been anticipated due to the economic slowdown there. U.S. demand for oil is actually declining, in large part due to government regulations requiring improved fuel efficiency standards for cars. Furthermore, global economic growth is weak, and there has been a very sharp slowdown in the growth in global trade. The IEA estimates global oil demand will be 92.4 million barrels this year and 93.6 million in 2015. In addition to supply and demand factors, we also have a very serious geopolitical clash between Russia and the Western powers, most specifically the U.S. Don't dismiss nor underestimate the desire of the United States to punish Russia for supporting pro-Russian separatists in the Ukraine. Russia is one of the world's largest oil producers. The Russian government finances depend heavily on oil sales. Therefore, the drop in oil prices is a severe blow to Russia. It is unquestionably well within the power of the United States government to push down the price of oil by selling oil futures short, covered or naked. The lack of transparency oversight within the $700 trillion over-the-counter derivatives market would permit the U.S. government to do this without being noticed or monitored. Since the tool is available to U.S. policymakers, and perhaps this is just the kind of situation that explains why the government has not imposed transparency on this particular market, no one should be surprised that they would employ it. The fourth is the financialization of oil. since the petrodollar came into existence in the early 70s. My co-host at Macro Analytics, Charles Hugh Smith, defines financialization as financialization is the mass commoditization of debt and debt-based financial instruments collateralized by previously low-risk assets, a pyramiding of risk and speculative gains that is only possible in a massive expansion of low-cost credit and leverage. That's a mouthful, but every word in there is telling and descriptive. Basically, financialization packages the risk in safe-looking securities and offloads the risk to the unsophisticated and unwary and unsuspecting. It's similar in nature to the games played in the mortgage arena before the financial crisis brought it all to light. It's exactly the same thing. Presently, a weak foundation of collateral is supporting a mountain of leveraged, high-risk debt and derivatives. Oil in the ground has been treated as collateral for trillions of dollars in junk bonds, loans, high-risk loans, and derivatives of all this new debt. The 35 to 40% decline in the price of oil has reduced the underlying collateral supporting all of this debt by 35 to 40%. We've had 40% decline in oil in the last 4 months. Loans that were deemed low risk when oil was $100 a barrel are no longer low risk with oil below $70 and closer to $63 a barrel. A dead cat bounce notwithstanding. Financialization is always based on the presumption that risk can be canceled out by hedging bets made with counterparties. That is wrong. It's transferred, and counterparty risk is always seen when markets correct. There are many consequences of the drop in the global oil prices, which we'll discuss in a moment, but front and center in my mind is the reduction in global liquidity and investment flows and collateral reduction. There is already, at these prices, a $316 billion hit to the OPEC cartel's revenues, which previously boosted global liquidity, spurred asset prices, and helped to keep borrowing costs globally down. The $316 billion figure would be is in fact much higher if other big exporting oil countries such as Russia, Norway, Mexico, Kazakhstan, Oman, etc. are all taken into account. I believe it's probably closer to $500 billion already. We've had, as I said, a 40% fall in Brent crude since mid-June, which will reverse the existing established longer-term trend. And for the first time in 20 years, OPEC nations will actually be sucking liquidity out of the market. Let me repeat that. Not just not putting it in, sucking it out. And I'll explain that in a second. In 2012, OPEC petrodollar flows into liquid investments such as U.S. Treasuries, high-grade corporate bonds, and equities stood at $500 billion. Next year, they could drop below $100 billion if price were to average only around $78 a barrel, which would be up from where it is trading here as of this morning. The U.S. is importing less oil than it used to, meaning fewer dollars are being sent abroad. Some analysts have said this could lead to a shortfall in dollar liquidity, and it will. This is the center of something called the Triffin paradox, which myself and Charles Hugh Smith have talked about extensively in Macro Analytics, and those tapes are in the library. The main impact of the reduction of petrodollar flows will be less on liquidity than on investment patterns. What a sovereign wealth fund might put their money into will be different to what an asset manager might favor. Don't underestimate just how big these sovereign wealth manager strategies have been, who are willing to take longer-term views than fund managers who are on a much shorter scale of their decision-making. If stressed oil producers are forced to sell assets to fund gaps in their domestic budgets, that could, in theory, be a good deal messier. And this is what I mean about having to take money out of the market and actually suck it back in to balance these budgets and these deficits to keep their own economies going, because there are so many subsidies that are built into their price structures within their countries to keep themselves in these sovereign leaders in power. Now, what about the consequences? Ultimately, the consequences will depend on two things: how far the price of oil falls and how long it remains low. How long it remains. Since we don't know the answers to those questions, let's focus on the consequences if the oil price stabilizes where it is now at, say, $68 per barrel for Brent. Consumers will be better off. Lower gasoline prices will be like a tax cut for the middle class, who will be able to spend more on other goods. I don't believe that will be significant. I think it's a better way to look at it, is they'll just be adding less dollars to their credit growth or their credit debt levels. Because they're already borrowing just to make ends meet now. But there will be some gains there, no doubt. The U.S. trade deficit will become smaller as the cost of oil imports falls, although this will be partially offset since Americans are likely to use their savings from a lower gasoline bill to buy more consumer goods made overseas. A lower trade deficit will boost GDP. Lower oil prices will mean more downward pressure on consumer prices and a greater risk of deflation. The fear of deflation is likely to cause the Fed and the Bank of England to delay their plans to increase interest rates, and I believe this is another reason this is being orchestrated. While it may force the European Central Bank and the Bank of Japan to accelerate their asset purchases. In most countries, government bond yields have already fallen in response to the increasing disinflationary, deflationary pressures that will result from lower oil prices. Government bond yields in a number of European countries fell to record lows last week. The finances of oil exporting countries will suffer. The currencies of Russia, Norway, Venezuela, Nigeria have already fallen significantly, reflecting the deterioration in those countries' economic prospects. Lower oil prices are likely to put some high-cost producers out of business. The Canadian oil sands look particularly vulnerable. Some of the marginal shale oil producers in the U.S. may also go to the wall, as no doubt bankruptcies occur. Defaults on energy junk bonds that John Rubino has talked about extensively are likely to rise significantly. At this stage, I don't believe that the losses in the junk bond market will be significant enough to cause a new financial sector crisis, nor do I believe that so many wells will shut down in the United States that U.S. oil production will begin to fall. Production costs have been falling rapidly and are likely to continue falling. Oil prices will have to fall considerably further before cost of the new shale oil production becomes truly unprofitable. Of course, the possibility that oil will fall much further can't be ruled out. It was $20 a barrel not all that long ago. And there's a lot of indications that we could see it significantly lower right now, so watch closely. Finally, the reduction in the U.S. trade deficit will mean a reduction in capital inflows into the United States. Capital inflows are the mirror image of the current account deficit, since every country's balance of payments must balance. The reduction in capital inflows will reduce the upward pressure on U.S. asset prices that has come from this source in the past. All of this is obviously serious, but it doesn't mean equity markets are going to collapse. In my opinion, the powers to be simply cannot allow that to happen. They're in a trap with few options. The biggest is unfunded pensions. We presently have $4.7 trillion in underfunded state and local pensions in the U.S., with another $3 trillion at the federal level and close to $1 trillion within U.S. corporations. This is very close to $10 trillion as interest rates remain near zero. Plans call for 8% or more within these pension plans. That's what they're currently built on. And with 75 million baby boomers retiring at a rate of about 10,000 per day, this frankly makes Bernie Madoff's Ponzi scheme seem like a joke in comparison. The governments of the world, and I include all the developed countries here, are in a similar fix to the United States. They have no choice but to print money to keep these asset prices inflated as long as possible, which means interest rates will stay the same or continue to fall, and the money printing will accelerate. When you know that, the elements of financial repression and the investment strategies that go with that become a very clear part of your portfolio thinking, if you buy into that. Stocks are topping. The dollar is topping, the euro is bottoming, oil is bottoming, gold and silver and mining stocks are bottoming, according to the technical charts that we're looking at. The US dollar has finished the final leg of a rising bear wedge, and the euro is finishing the final leg of a declining bullish wedge, telling us that the US dollar may rise towards 90-ish and then could fall sharply. That's not imminent, though. While the euro could decline towards 122-ish and then should rise sharply. Those trend-terminating patterns should finish over sometime over the next week to couple months. This should support our bullish outlook for gold. Given the multiple bearish divergences between prices and underlying internal condition measures that have been getting more pronounced every day and we've been talking about for months, tell us that fewer stocks are participating in the rally from October the 15th, and we have to pay close attention to any decline that may be starting now. These divergences are pretty large. That tells us that decline coming out of them will also be large. Similar bearish divergences were seen before the recent September-October stock market plunge. There is an open gap at 1905 in the S&P and 16,401 in the industrials and at 3872 in the NASDAQ 100 that occurred during the parabolic rally from October the 15th. This tells us that prices could drop substantially to these levels during a near-term decline, possibly during the next significant decline that is identified by new sell signals occurring in our key indicators. But I don't believe that this is going to cascade. I believe that you'll see actions that will reverse this, and it's my opinion currently that we still have newer highs to be seen in 2015 after we go through this turmoil that we will see in early first quarter with tax gains. Of all the gains that have been had through 2014, those are deferred into 2015 and portfolios then sell and rebalance. In the short term, I expect a little weakness here in early December, followed by a Santa Claus rally, and then, as I mentioned, tax gain selling and portfolio repositioning in early Q1. After that, we head higher for no other reason than the ongoing printing of these sovereign powers with no escape route, guaranteeing of collateral, and other techniques that will come out of the central bank. There's no question they are concerned, but they have not reached the point of panic when they will pull out more rabbits out of the hat. None will fix the problem, but it will push this on. This will kick the can down the road even further. I fully expect a Minsky melt-up before all this ends very badly. In my opinion, in late 2015 or early to mid-2016. Eventually, it will be clear to all that the central bank policies have been an abject failure. The government's policy of financial repression is becoming too heavy-handed, and that jobs continue to simply disappear. And when I say jobs, I'm talking about jobs that can support a family. Here is something further to think about. Just imagine the extraordinary upheavals that will occur in the markets and in geopolitics when the realization eventually sets in that new technologies will potentially make oil practically worthless sometime before the middle of the 21st century. That's a pretty shocking statement. That is not what is going on presently, but this is the sort of shock we are likely to see in our lifetime. That technology realization still appears to be, as I said, some time off. However, between now and then, we are likely to see a number of other big swings in the price of oil, energy, natural gas, both up and down, which will have profound impacts to the global financial markets. And that is because they are about currency movements. The currency markets trade 5.8 trillion a day. The second biggest gorilla, substantially smaller, is the $100 billion bond market. The stock market of global equities is only 60 billion. Frankly, it's the tail on the end of the dog. When oil starts to move, it's right at the head of the dog. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening. And until next month, I hope that 2014 turned out to be an outstanding investment year for you. And I'm very excited about what we will see in 2015. Talk to you again next month.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.